Welcome to this video about avoiding common mortgage mistakes to save yourself time and money. As an expert in the mortgage industry, I have seen many homebuyers fall victim to these mistakes, which can lead to frustrating and costly delays in the home buying process. By avoiding these mistakes, you can not only save time and money, but also ensure that your mortgage application is approved smoothly and efficiently. Now, you might be wondering, what are these common mortgage mistakes that I should avoid? Well, in this video, I'm going to share with you some of the most prevalent mistakes that homebuyers make when applying for a mortgage. From not getting pre-approved to not understanding the different types of mortgages available. These mistakes can lead to headaches and potentially even derail your homeownership dreams. So, if you're ready to take control of your home buying journey, stay tuned as I dive into these common mortgage mistakes and provide you with actionable tips and insights to help you avoid them. By the end of this video, you'll be armed with the knowledge and confidence to make informed decisions when it comes to applying for a mortgage. Let's get started. One of the most crucial steps in the mortgage application process is getting pre-approved. Yet many homebuyers overlook this important step. Pre-approval not only gives you a clear understanding of what you can afford, but it also provides assurance to sellers that you are a serious buyer. In fact, many sellers require pre-approval before even considering an offer. The consequences of not getting pre-approved can be significant. Without pre-approval, you risk wasting time and effort looking at homes that are outside of your budget or that you can't afford at all. Additionally, if you find your dream home and don't have pre-approval, you may lose out on the home to another buyer who is pre-approved. So, how can you ensure that you get pre-approved? One tip is to gather all the necessary documents before meeting with a lender. This includes pay stubs, tax returns, bank statements, and other financial information. It's also important to be honest about your financial situation and credit history, as this can affect your pre-approval. Getting pre-approved is a critical step in the mortgage application process. By understanding the importance of pre-approval, the consequences of not getting pre-approved, and the tips for securing pre-approval, you can save yourself time and money and increase your chances of homeownership success. When it comes to applying for a mortgage, one of the biggest mistakes that homebuyers make is not shopping around for lenders. Many people assume that all lenders are the same. But in reality, there can be significant differences in rates, terms, and fees. Shopping around for lenders is important because it can save you thousands of dollars over the life of your loan. Just a small difference in interest rates can have a big impact on your monthly payments and overall mortgage costs. By comparing rates and terms from different lenders, you can find the best deal and save yourself a lot of money in the long run. So, what are the differences between lenders? Well, there are a few key factors to consider, such as the types of loans they offer, their interest rates and fees, and their customer service and support. Some lenders specialize in certain types of loans, such as FHA or VA loans, while others may offer a wide range of loan options. Additionally, some lenders may have lower interest rates but higher fees, while others may have higher rates but lower fees. When it comes to finding the right lender, there are a few tips to keep in mind. First, do your research and compare rates and terms from multiple lenders. This can help you get a sense of the average rates and fees in your area and identify any outliers. Second, read reviews and ask for recommendations from friends and family. This can give you insight into the customer service and support provided by different lenders. Finally, don't be afraid to negotiate. If you have good credit and a solid financial history, you may be able to negotiate a better rate or fee structure with your lender. Shopping around for lenders is an important step in the mortgage application process. By understanding the differences between lenders and following these tips for finding the right lender, you can save yourself time and money and find the best mortgage for your needs and budget. When it comes to choosing a mortgage, there are a variety of options available. Each type of mortgage has its own set of pros and cons, and it's important to understand the differences before making a decision. One type of mortgage is a fixed-rate mortgage, which has a set interest rate for the entire life of the loan. This type of mortgage provides stability and predictability in monthly payments, making it a good choice for homebuyers who want to avoid any surprises. However, fixed-rate mortgages typically have higher interest rates than adjustable-rate mortgages, which can make them more expensive in the long run. Another type of mortgage is an adjustable-rate mortgage, ARM, which has an interest rate that changes periodically based on market conditions. ARMs can offer lower initial rates and lower monthly payments, But they also come with the risk of rates increasing over time, potentially causing monthly payments to rise significantly. A third type of mortgage is a government-backed loan, such as an FHA or VA loan. These loans are insured by the government and often have lower down payment requirements and more flexible credit score requirements. However, they also come with additional fees and requirements, such as mortgage insurance premiums. So, how can you choose the right mortgage for your needs? One tip is to evaluate your financial goals and priorities. Are you looking for stability or flexibility in your monthly payments? Do you have a large down payment saved up, or are you looking for a loan with a low down payment requirement? By understanding your financial situation and goals, you can better determine which type of mortgage is right for you. Another tip is to work with a reputable lender who can help guide you through the process and explain the pros and cons of each type of mortgage. They can also help you compare rates and fees to find the best deal. Understanding the different types of mortgages available and the pros and cons of each can help you make an informed decision and save yourself time and money in the long run. By following these tips for choosing the right mortgage, you can find the best loan for your needs and achieve your homeownership goals. Buying a home is a major financial decision, and it's important to be aware of all the costs involved. When you apply for a mortgage, there are several fees and expenses you need to be prepared for. These costs can include closing costs. These are fees charged by the lender and other parties involved in the home purchase, such as appraisers and title companies. Closing costs typically range from 2% to 5% of the home's purchase price. Down payment. This is the amount of money you need to pay up front toward the purchase price of the home, depending on the type of loan you choose. Down payment requirements can range from 0% to 20% of the home's purchase price. Private mortgage insurance, PMI. If you put down less than 20% on a conventional loan, you may be required to pay PMI. This is an additional cost added to your monthly mortgage payment. Homeowners insurance. This is insurance that protects your home and personal property in the event of damage or theft. The cost of homeowners insurance can vary depending on your location and the value of your home. Property taxes. These are taxes levied by local governments on the value of your property. Property tax rates can vary widely depending on your location. To calculate the costs involved in a mortgage, you can use a mortgage calculator. This tool will help you estimate your monthly payments, including principal and interest, as well as additional costs such as PMI, property taxes, and homeowners insurance. To budget for a mortgage, it's important to have a clear understanding of your current expenses and income. You should aim to keep your monthly mortgage payment, including all additional costs, at or below 28% of your gross monthly income. This will help ensure you can comfortably afford your mortgage payment without stretching your budget too thin. Being aware of the costs involved in a mortgage and budgeting accordingly can help you avoid financial stress and set you up for success as a homeowner. By understanding how to calculate mortgage costs, budgeting for additional expenses, and using tools like mortgage calculators, you can make informed decisions about your mortgage and achieve your homeownership goals. When it comes to mortgages, the devil is often in the details. And that's why it's crucial to read the fine print. Failing to do so can lead to unexpected surprises down the line, such as hidden fees, penalties, and restrictions. The fine print of a mortgage agreement contains important information that may not be included in the main terms and conditions. This can include prepayment penalties. These are fees charged by the lender if you pay off your mortgage early. Not all mortgages have prepayment penalties, but it's important to check the fine print to make sure you're not caught off guard. Adjustable interest rates. Some mortgages have variable interest rates that can change over time. The fine print will outline how and when your interest rate can change, as well as any caps or limits on those changes. Restrictions and requirements. Your mortgage agreement may contain specific requirements or restrictions, such as limits on home improvements, or a requirement to maintain certain insurance coverage. To understand the fine print, it's important to take your time and read through the entire agreement carefully. Don't hesitate to ask questions or seek clarification on anything you don't understand. You may also want to consider working with a lawyer or financial advisor who can help you navigate the terms and conditions of your mortgage. Additionally, before signing a mortgage agreement, make sure you have a clear understanding of all the terms and conditions, including any additional fees or charges. Don't be afraid to negotiate with the lender if you find any terms that are not to your liking. Reading the fine print is essential when it comes to mortgages. By taking the time to carefully review the terms and conditions of your mortgage agreement, you can avoid surprises and ensure that you're making a sound financial decision. Remember to ask questions, seek clarification, and negotiate with the lender to get the best possible deal. In conclusion, we've covered some of the most common mortgage mistakes that can cost you both time and money. Not getting pre-approved. Not shopping around for lenders. Not understanding the different types of mortgages. Not knowing the costs involved in a mortgage. And not reading the fine print are all mistakes that can be easily avoided with a little bit of knowledge and preparation. It's important to keep in mind that getting a mortgage is a big financial decision that can impact your finances for years to come. Taking the time to avoid these mistakes can ultimately save you thousands of dollars and a lot of stress in the long run. So, what can you do to avoid these mistakes? First and foremost, make sure to do your research and understand the mortgage process inside and out. Shop around for lenders, get pre-approved, and compare different mortgage options to find the one that best fits your needs and budget. And of course, always read the fine print and seek professional advice if you have any questions or concerns. If you found this video helpful, please leave a comment below and let us know your thoughts. And don't forget to subscribe to our channel for more helpful tips and advice on mortgages and personal finance. Thanks for watching.